So let's continue. I'm sorry for the power cut. I'm somewhere in Africa, so thank God we don't have a live lecture. So anyways, so let's continue the equation. So we were saying that we're trying to find the connection, right, between k and 1 over v. And here we were saying that we should divide both sides by py. So you will get here mv over py, and here py over py is just simply 1. So in other words, you can write v as equal to 1 over m, right, divided by py. Okay, and we can also think about, okay, can I rewrite the reciprocal of this one? Like I can actually write it. I thought I can get more space, but anyways. So let's see, the reciprocal of this one is gonna be like 1 over v, if you like just get the divided by 1, and then this would be m over py. Okay, and now if you compare the left part of the real money demand with the right part that has the real money supply, then we can get the connection. So I want you to think about it like from here we're getting that k is equal to m over p to the power d, which is the demand, right? Everything divided by y. And from here we're getting that 1 over v is equal to m over py. Okay, so if I just can isolate one part here, so if we assume that in equilibrium the real demand for money is equal to the real supply of money, okay, and the y is equal to the y, then I can get this part to be equal, which what we have here. Okay, so, and this is under the big assumption that the real demand for money is equal to the real supply of money. Demand side equals supply side in equilibrium, then I can cancel these two together, I can cancel the y together, and I'm left with this equality, right, which says k is equal to 1 over v. What is the 1 over v? So k is equal to 1 over v. What does that mean? The higher the velocity of money, the less the fraction out of my income that I need, right? The higher the velocity, the lower is the fraction out of my income that I need for transactions, and it makes sense. And the opposite is true. Okay, when people hold a lot of money relative to their income, or when k is large, money changes hands infrequently, so v is small, so we get this negative relationship between k and v. And I'm sorry for all this big mess of writing, but the idea by the end is simple. You don't have to memorize the derivations, but I appreciate when someone is asking me how you got this, so we can go over the steps. But again, I don't expect you to derive the equation, but just understand the idea. Okay. One other question I got about the definition of money. So let's go back here before we continue. So we said this is the simple definition of money, which is basically the cash in our pockets, the checking accounts, travelers accounts, all of these are checking accounts, like your own money, okay? And then the broader definition of money, the M2, this is the one that is officially used by the Federal Reserve Bank when they refer to money supply. They basically refer to M2, which is everything in M1 plus small time deposits like CD, certificate of deposits. Okay, so it has like small denominations for a relatively shorter period of time, or saving deposits that is relatively longer period of time, or probably have more restrictions on how many transactions that you can make per month, for example. And then you have the money market mutual funds. This is the short-term securities investment, right? And the money market deposit accounts, and this is relatively for a longer period of time. And why they use the M2. They basically use M2 because it gives like a broader definition of money. It's not only your checking accounts, right? But it also includes securities, right? Saving accounts that earn interest rate. So, for example, the very last one, which is the money market deposit accounts, would be like those saving accounts that have higher interest rates but also higher restrictions. Okay, it has like minimum balance requirements, limits on transactions, right? So all of these restrictions. All right, so let's continue our topic, and I think we stopped where? So we were talking about the quantity theory of money, and yes, this is the slide that we stopped at in the previous two videos. And then, so we were saying that inflation has a connection between the growth of money supply and the GDP, okay, the growth of GDP or economic growth. We hope that we can find this balance between the two. Some growth of money is acceptable, right? So certain amount of money supply growth is acceptable to facilitate transactions, but we hope that this is not going to be in excess of the amount of actual production, because this would lead to inflation, and not only inflation, can lead to hyperinflation. And here I want you to refer to the video on Zimbabwe and the hyperinflation. And the main idea behind hyperinflation in that case was that the growth of money was way exceeding the ability of the economy to produce. So that led to hyperinflation when the economy was printing money. So the printing of money led to a huge increase in money growth, which was way above the growth of the productive ability of the economy. So yes, we accept certain amount of money supply, but it has to be in such a way that is not too much in excess of the production or the productive capacity of the economy. So the quantity theory of money has implications, right? When you think about, okay, what are the factors affecting this part, we know that. So it has the factors of production, technological progress. You think about what are the factors that are responsible for economic growth, because this is economic growth. So you would say, okay, what are the resources available? Factors of production, I'm going to write it as FOP, but you already know that those are for labor, capital, land, and entrepreneurship. And also you can add the technological ability of the economy. We will talk about this economic growth on the next topic, which talks about economic growth and factors affecting economic growth. And specifically, we will talk about the Solow model, which is a very important model in the economic growth field. Right? So the quantity theory of money predicts that we have one-for-one relationship between the changes in money growth and the inflation rate. So there is one-for-one relationship. So when we look at the data, it's very important to always compare what the theory predicts versus what we see in real life. Like, do they match? And this is very important. And the success of a theory depends on how we can apply it in real life. So when you look at the main implications behind the quantity theory of money is that countries with higher money growth should have higher inflation, right? And also the long trend behavior of a country's inflation depends on the country's trend, long run trend of money growth rate. So there is a connection not only in the short run but also in the long run between the money supply and inflation. So let's see that, whether we can see that in the data. So getting data for a group of countries, and on the x-axis you have the supply of money, the growth of money supply, and then here we have inflation. And we have a scatter plot. This is called a scatter plot when you see like these dots. And if you're taking econometrics course, or if you're actually like just plotting this on Excel, you can try to fit a line that passes through most of these points, and just by looking at by the eye, you think that most likely this line is going to be somewhere like this, a positive relationship between the growth of money supply and the growth of inflation. So based on this study, it was able to confirm that this relationship is positive. But how strong is it, like statistically significantly important or not? This is something beyond our course. How strong is it? 90% correlation? Is it 60? Is it just 40? Again, this is beyond our course. But for our course, just looking at these dots and trying to imagine that you can fit a line that passes through, or you can draw a line that passes through these dots, would give us an indication about, okay, this is the, like, around the range of data, right, which looks like positive relationship. Also, looking at the time series analysis of inflation rate versus M2 growth rate over time. And this, as you can see, like we have spikes up and down, but what matters is the long-term trend, and this is like the long-term relationship. And you can see that they are kind of moving together, right? So this, again, another way to confirm that what the quantity theory of money predicts is matching the data. Okay. The seigniorage is just a word that is related to printing money, which is basically spending more without raising taxes or selling bonds. So just printing money. So the revenue from printing money is called seigniorage. Okay, so seigniorage can lead to, as we said before, if it is not controlled, can lead to hyperinflation. And this is what we call a tax, right? So inflation can be considered a tax, especially on people who have fixed income. Okay, so people who have fixed income, they would consider inflation, or for them inflation would be some kind of a tax on them. Those who have fixed income, those who are retirees, those who are borrowers and paying back, and so on. I'm sorry, not borrowers, lenders who are receiving their money back, who they started to lend when the prices were low, but then they are getting their money back when the prices are high. Those are worse off. All right, and the interest rate equation, or the real interest rate equation, is simply, I'm just gonna text someone who's calling me. All right, so inflation and interest rate, we can also get this relationship by saying that real interest rate is equal to the nominal interest rate minus inflation. In other words, we can adjust inflation, right, which is the real, we can adjust interest rate, which is the real interest rate, by subtracting inflation from the nominal interest rate. Okay, this is exactly what we did with real GDP and nominal GDP. So the real GDP, any variable that you want to adjust, okay, so you would subtract its nominal version minus inflation. Okay, and again, here when I write it this way, it has to be in percentages, right? Inflation is in percentage already, but if I want to write it in terms of dollar value, then it's going to be like real GDP over is equal to nominal GDP over the price index, let's say deflator. Okay, just notice that when I write it in terms of a division, then it's in dollars term. When I write it in terms of subtraction, then I'm taking the log, as we did in class. You take the log because the log would transfer a variable into percentage change, right? And as we can see in the graph here, like see percent logarithmic scale, because the log will transfer the variable into percentages. All right, and sorry, where are we? Okay, and from here we can get what we call the Fisher effect. Okay, so the Fisher effect is simply providing a certain connection between the real and the nominal interest rate. So in equilibrium, we have the supply of funds equal to the demand for funds, right? And we out of this equilibrium, we can determine R, which is this one. Let's assume this R is fixed. So the connection between inflation and nominal interest rate would be 1-for-1. The higher the inflation and the higher the interest rate, and this is what, or the higher the nominal interest rate, and this is actually what we see today in the economy. We see inflation is going up, interest rate is also going up. Why? Because the Fed is taking these measures or these steps in order to cool down inflation, in order to reduce inflation. So looking at the data, nominal interest rate versus inflation. The inflation is in the orange, the nominal is in the blue. Again, we see that they are moving together, and this is what we see in the market now. Inflation and interest rate, they move together. Anytime inflation is high, the Fed is going to take the measures to increase interest rate in order to cool down inflation. As inflation starts to cool down, the Fed will not take the measures to increase interest rate, but it might keep it steady as their last meeting, or actually their plans to cut interest rate in the coming year. So they, in other words, you can think of it as this way: interest rate depends on inflation, right? So interest rate depends on inflation. You can also write this inflation as pi. And this interest rate, notice that the I stands for the nominal interest rate, the R stands for the real interest rate. So what is announced in the news, or what you read in the newspapers, or what the Fed is referring to, is the nominal interest rate. So the nominal interest rate is always following the situation in prices or the situation in inflation. So again, the data is matching what the Fisher effect is predicting. Also, when you look at a cross-sectional study, right? So this cross-sectional study is about nominal interest rate, and again, it's in log. And as you can see, this is inflation and this is the nominal interest rate. By just trying to fit a line here, right, you can see it's a positive relationship. As the inflation rate increases, nominal interest rate would follow an increase. We have one outlier here, but again, you already know why we have this outlier, which has a super high, right? See, super high level of inflation rate. It's there. We can continue the line and go up to this point, but all of this is not supported by data, so it's better to forget about this part, right? And say, okay, we're not considering this part because it's an outlier. So this is econometrics kind of topic. Econometrics where we talk about the outliers and so on. So we can just forget about this, say this is an outlier, and we can just focus on the concentration of data here and say, okay, it's a positive relationship. All right? So this is basically it towards the end of our topic. I want you to read the summary and make sure that you follow on the points that we discussed so far. One last thing that we're going to do is I'm going to do 2 practice questions. So let's keep this to the next video.